Hey everyone, welcome to the DPI podcast, where we talk to the top pre-seed GPs to deconstruct pre-seed investing. I'm Vignesh, and I'm a partner at Sierra Ventures and your co-host here.
Hey, this is Brendan. I'm a principal at Sierra Ventures. Super thrilled to have Sunil on for episode 2. Sunil is a solo GP at Ubiquity Ventures. They coined the term software beyond the screen and describe themselves as nerdy and early capital. Some of my favorite phrases, but Sunil is a true pre-seed investor, oftentimes pre-incorporation, and really interesting background. So Sunil, welcome.
Hey guys, thanks for having me on. Good to see you again, Brendan and Vignesh.
Yeah, thanks for taking the time, Sunil. First question I want to ask is, what's the origin story? You have a really interesting background. You first founded a company, ML-based dating app called Triangulate, and then you moved to Bessemer, and you invested on the software side with Auth0 and Zapier. But you also started doing some deep tech frontier software type stuff like Rocket Lab and Tile. So walk us through, how did you land on Ubiquity and your thesis, and what's sort of the origin story of the firm?
Yeah, well, thanks for asking. So I've always liked to put my hands on tech, to immerse myself in technology. I use the word nerd because it's my shorthand for folks who go 100 times deeper into something. You can be a sailing nerd or a tech nerd. And I say this going back to when I was a little kid, playing with computers and programming languages, just messing with them and trying to break them, mess around with them, and go into the innards is something I've always loved to do. And I realized that makes me a little bit of a quirk in the venture industry versus looking at a sector from like the business potential. I always start with product. I always start with the technology. The origin story for Ubiquity has to do with my time at Bessemer. I was at the large VC firm, Bessemer Venture Partners, from 2011 to 2017. And a few years into that, I started to find my footing. I was one of the more active seed investors and definitely one of the more technical investors. And we started to spend a little more time in deep tech. It wasn't really called that back then, but it was definitely off the beaten path investing. And so I met this company that was like a 10-person company. CEO's name was Pete. He came in and presented his idea. It wasn't, on the computer. He brought in a rocket engine. He opened up this like Pelican case and put the rocket engine on the table and said something that I think would have not resonated with most people. For me, I started to unpack it and realized how big of a deal it was. His rocket engine was the world's first and only rocket engine that was reconfigurable. That is, after he built it, he could change the way the engine worked. To go a little more technical, he had the world's first electric turbopump inside of his rocket engine. Wernher von Braun, the father of the US space program, I think he said a rocket is nothing more than a turbopump with stuff attached. Peter Beck's rocket engine, called the Rutherford engine, he was able to change the way it worked with lines of code. So to me, this was a big deal, and it became an even bigger deal over the time. And in many ways, this was my very first software beyond the screen investment. 3 years before I left Bessemer to start Ubiquity. It was a physical thing that was really a place for software to take over. Now, let me jump ahead. We invested in Rocket Lab at something like a $30 million valuation. It's now public at a $45 billion valuation. And catching this deceptive technology that looks like hardware, it looks like metal. It was in a sector where everyone knows space is hard. To look past that and go into the underlying trends, the underlying physics, the underlying science, the underlying software was really lucrative. So wrote that whole investment memo. We invested in the company. I was with Peter Beck when he literally pulled the curtain off of his Rutherford engine at the Space Symposium in April 2015. That summer, we were together as he won his first launch contract at Kennedy Space Center. And since then, the company's been on a tear. Today, they're the only other company besides SpaceX regularly going to orbit, dropping off payload. I think it's now 80 successful times to orbit, dropping off payload. And you look at this against the landscape of other rocket companies, which have all failed along the way. So I view it as sort of the first software beyond the screen thing. The first time I saw that where I could slot into the venture ecosystem differentially and find stuff that others would dismiss. And a few years later, I decided to launch Ubiquity with that core theme of what I call nerdy and early investing in software beyond the screen.
Well, I know you were at the Artemis 2 launch, and so hopefully you got a chance to see
You
rocking my
did.
up close and
So
personal again.
I do. I need my space, and it was a great time to see the first time in 54 years we've sent people anywhere near the moon, and it was the most powerful rocket ever launched from Earth, 8 million pounds of thrust. So a very cool day.
I could talk to you a lot more about this, and maybe we'll come back to this at the end. But I think it's interesting to think about the what's possible now that the cost of going into space has come way down, and I'm sure that's part of this drives kind of your investment thesis. But like, let's go back to the beginning, and we're gonna come back to this topic later on, which is around moonshots and physical AI, and like in today's world. But like when you started doing, what you were doing or at Ubiquity, it was not a popular like thing to be a deep tech investor. Software beyond the screen was not a popular thing. Maybe talk about this from two perspectives. One, what shaped your conviction behind the thesis? And then two, how did you convince LPs that it was the right strategy?
Yeah, it's a tricky animal because now we're 9 years later, and the two elements of Ubiquity at the time, solo GP and deep tech, are actually pretty common now. So it doesn't seem very controversial. But at the time, there were almost no solo GPs. In fact, many of the folks I consider mentors, like Manu Kumar and Jeff Clavier, they weren't really like solo GPs in the spin out context, right? They grew up from Super Angel upwards. They've been fantastic. I love working with them this day. I don't mean to dismiss their contribution, but their path was very different. There were very few people who were at a big firm and decided to leave. So spin out managers. There were very few solo GPs. And then deep tech was barely a word. And even to this day, it's relatively fuzzy as to whether it means quantum or nuclear or whatever. We'll talk about my sliver. So you asked kind of what gave me conviction. I was at a large firm, and I appreciated the learning and the approach and the process. But I also saw all the ways between my old firm and many other large firms, all the ways that like so much time is wasted on things besides investing. We already know the best investments are the non-consensus investments, and yet the firm and big firms are set up to sort of drive to consensus. The cycles spent on bringing others up to speed, to winning over, political favors, trading back and forth. There's just a lot of things that get in the way of high agency, high incentive investing. And so I knew that I wanted to set up the firm as a solo GP firm with my neck on the line if things go poorly, and my wallet, which will benefit if it goes well, right? Sort of that economic incentive and responsibility. I also really like the personal touch. I'm still a builder. You mentioned the old startup I used to have. I still think of Ubiquity as a startup in building. So there were a few kind of ideas swirling around, and I'll be the first to admit, I also was just swinging really far away from multi-stage, multi-partner, multi-office, multi-billion. Every one of those dimensions, I took the opposite approach. At the time in 2017, one person, one stage, one sector, one office. And I'd say a little bit luckily, it worked out really, really well in that context. And so as I tried to convince LPs of this, it was very hard. It was very, very tricky to figure out whether I was able to flip an LP over. Most LPs were just not up for it. They were just like, nope, we have a rule, we have a framework, it needs to be multiple partners. But I was able to convince a meaningful number of LPs, including some institutional, some major universities, et cetera, even on my fund one, that the trade-offs were worth it. I try not to say one is better than the other, but with multi-GP, there's some benefits. With solo GP, there's some benefits. And I was able to convince some folks to come over. And I think those LPs have been with me now for 3 funds and appreciate that you can have an institutionally run firm with great returns if you sort of have the right combination of inputs, and one of those inputs can be solo GP.
Sunil, I think next thing I want to touch on, so I think you won the award for most diverse portfolio, like, listing some of the spaces you've invested in: cows, satellites, school buses, hospital robots, optical prescriptions, earthquake monitoring, and so on and so on, which is really cool. Like every time I'm going through your portfolio, I'm like, what's the new cool thing that Sunil's going to invest in? What ties all this together? I know that's kind of broad on spaces, but I know there's a method to the madness behind the scenes. What's sort of like the tying theme? What do you look for in founders? I know this spans a few funds, so would love to hear your take on this.
Yeah, thank you for doing all that homework on the portfolio. It's actually the genesis of the name Ubiquity, is ubiquitous software showing up everywhere software beyond the screen. But in the real world, it can show up in all these different incarnations. So it's a good question. Like, what is the commonality? I'll tell you, when you and I see each other at networking events, VCs introduce themselves and they say, I'm a consumer VC or I'm an enterprise VC. Sometimes they'll say, I'm a supply chain VC. I'm not really a snowflake, but Ubiquity does sort of span all of those things. So then the question remains, what's the unifying thesis? For me, it's this notion, back to Rocket Lab, that you can have things in the real world that embody the characteristics of software. Very precisely, they can be updated over the air, they can improve, they can send back analytics. I know this sounds obvious, but like this, bracelet I'm wearing here has none of those things, right? Like somebody made it based on a whim. They have no idea if it's doing its job. They can't update it. They don't get any additional revenue over time. But all the software we're using, including this tool we're using today to record this podcast, has settings, analytics, and updates. I gave a 1-hour talk at Xerox PARC a few years ago about this idea of that software has these characteristics and now they can come to the real world. So when you talk about earthquake monitoring or hospital robots or satellites, the unifying theme is that they are all examples of software beyond the screen, specifically updatable software, light CapEx, reconfigurable, over-the-air updatability, ongoing recurring business models. They have potential for expansion, what we now call NDR, net dollar retention, positive over 100%. So it fits together. And then a lot of the companies have a familiarity with hardware, with soldering, circuit boards, supply chain, CMs, battery consumption trends and things like that. And that actually helps. So when I have CEO events, 45 Ubiquity investments, we're able to have the folks talk in that language as well. So they're all thinking about similar technologies, but they don't cleanly fit into a particular vertical focus. They have this unifying technological theme that ties it all together.
I think this is maybe a good segue. I think I want to come back to this whole idea of moonshots and physical AI and kind of how you think about that. But I don't remember if this was something we were talking about when we ran into each other last week, or if I read this. But I think you said one of the things that was interesting about Halter, and maybe as you answer this question, talk a little bit about what Halter does. But I think one of the cool things you said was that like Halter initially tried to use this like special band. Turns out like the band was not a good idea, and just using a regular buckle was like a way better way to. So you got to be smart about where you use technology, where you stick with like things that are tried and true. And I'm curious, as you talk to these founders, how do you make sure that you get the right balance? Like founders that are just sensible about design, but also like know where to push the boundary.
Mm-hmm. Yeah, this is a great question, and it's true for all tech founders, especially true in deep tech. It's a walking contradiction. You have to have a founder that's willing to throw away a nice stable job because they are able to have thick skin, ignore feedback, and at the same time have thin skin and take lots of feedback from customers, right? Like that's one of the contradictions. Another one is there's so many contradictions. Another one is you have to be super deep on the technology. And then at the same time, when you talk to different people, not talk about the technology at all. And so like, how do you do that? How can you be so knowledgeable and passionate and nerdy about the tech and then turn that off completely and then just talk to someone about, let's say, the business value of the product? So it's a tricky animal when you look at it, animal like Halter. So let's dissect that a little bit as to the signals I look for. So Halter is a really unique company. It's a great example of software beyond the screen, software jumping off the computer screen, running in the real world, ideally actuating the real world, not just monitoring like IoT, not another stupid Wi-Fi toaster in your kitchen, but solving a high stakes problem in an overlooked sector. And so I met Craig. He had worked at Rocket Lab, the investment we talked about earlier. He left, and I met him in Palo Alto. We sat down for 45 minutes at Il Fornaio in downtown Palo Alto. And at the beginning of it, he says, hey, I have this idea for improving cow farms. And I said, did you say cows? He said, yeah, cows. I grew up on a dairy farm. This is him talking. I grew up on a dairy farm, and I just know there has to be a better way. So like the first checkbox there is like an informed domain expertise and then a passion for solving the problem. That's really authentic. His parents still owned a dairy farm, and he had this idea to put a collar. Now, I keep very few things on my desk, but this is one of the things I keep on my desk. Maybe it'll show up properly here. This is our 5th generation collar, but it wasn't designed at the time. He had like a prototype in his hands. This is in 2018. And he said, yeah, if I put this collar on cows, I said, no, I know what you're talking about, Craig. You can see where the cows are. He said, no. I can actually move the cows. I said, what are you talking about? He said, well, you can move your finger on your phone and 500 cows, typical dairy farm in New Zealand, all the cows will turn and start walking one direction. My mind was blown. My nerd C++ background, I was thinking, oh, so each of these cows is like an object with methods and setters and getters. There's an SDK for a cow. They have an API, however you want to describe it. And then I started wandering, which is kind of like a lot of the Ubiquity thesis is what else is software like about this? He said he can write scripts, time-based scripts, so all the cows can come to the milk shed at 6 a.m. I'm thinking in Linux speak a cron job, setting up a recurring cron job automatically. He said he can tell which cows haven't eaten that much because of the way their head is tilted. So there's an accelerometer in the collar. So now we can actually write, he said, not algorithms, but cowgorithms, kind of as a joke. Now it's a serious word we use, cowgorithms, to be able to tell which cows haven't eaten that much. I'm thinking, oh, it's like an if-then statement in a for loop running through the 500 cows. So all of this is translating back to code, which is great because that was the focus of the fund. So I committed on the spot to co-lead his seed round back in 2018. And it's come together over time. But to your comment on the buckles, and really just in general, bringing software on the screen, there's a whole host of surprising problems along the way. And each problem actually creates a moat for people who are behind you that it'll be impossible to catch up or much harder to catch up. So we had a whole host of quirks. For example, with solar panels on a collar on an animal, you get a small amount of cracks that can accumulate over time that you don't notice at the beginning. And there's probably 50 other hurdles along the way. But there are these things, and this is in this world of physical AI, which I think has gotten a lot more interest recently because of SaaS is eroding, the SaaS sector is eroding moats. You're seeing a lot of folks come in, but there's a whole bunch of other things in physical AI that have to be accounted for. And Halter's now 8 years since I invested. We're now on 1 million cows. We've surmounted a lot of these obstacles, and we still run into small things here and there. But now, like all the Ubiquity companies, we've mostly transitioned from focusing on hardware to focusing on the software and cloud platform instead.
Sunil, let's double click on the SaaS apocalypse and how that's affecting deep tech and frontier AI in a bit. First of all, funny anecdote. I think when I met you back in like 27 or 18, Halter was, I think, the first deal you recommended to me, and one of the first deals I pitched to the Sierra team, and I think I botched it, in our meeting. But we'll add that to the Sierra anti portfolio over the years. But congrats on all the success with that one along the way. Tying into Halter though, Craig says you're the fastest investor ever to commit. You talk about yourself moving at founder speed. What does that mean to you? Like going back to the solo GP thread, why is that important? What does that mean to you? What do you think other VCs sort of get wrong and maybe mucking up the process a bit and making decisions?
Yeah, this is a really good question. I'll tell you, when I was even to this day, when I pitch LPs like a large university, let's say, and they invest in a lot of different asset classes. They might invest in real estate, stocks, bonds, lumber, venture capital. When I say I move fast, the only thing they hear is, why don't you take your time and do a good job? Like that's what's going through their mind. And so those are sort of opposites, right? Is like fast is the opposite of being thorough. Another thing about other asset classes is there's very rarely like a disappearing window of opportunity, right? If you want to buy Tesla stock today or tomorrow or next month, take your time and do the diligence, or a hedge fund, do all those channel checks. So part of the reason moving fast is important is because at this stage, deals move quickly, and also at this stage, a third of the companies I back are day of incorporation. As more progress occurs, the valuation goes up as well. And I think there's often a fallacy about valuation. Like, what does it matter, 10 million pre or 15 million pre? If it's going to be big, it's going to be big. I fundamentally disagree with that. The difference between 10 million pre and 15 million pre is 50%, right? That means you will make 50% less money one day, right? That's a big deal. And I feel like people don't make a big deal about that. If I just add the word billion, hey, do you want to invest in Anthropic at 10 billion? Not Anthropic. If you want to, that's too easy. Anthropic at 100 billion or 150 billion, people would think about it, but it's identical, the same difference between 10 million pre and 15 million pre. So if you move fast, you can secure attractive valuations. You can capitalize on your edge. If you do have intellectual edge where you've gone deeper in a sector, or have a prepared mind before you meet a company, then you actually can get paid for deciding a little more quickly. There's also an element of at this pre-seed stage, it's a little dangerous here, but you can overthink it too much. And I've run into that problem a few times where you sort of ask too many questions and sort of tie yourself in circles. I've done my own internal analysis on these 45 investments, and without exception, every single one of my top investments has been a decision within about 24 hours, which is a little bit crazy because that's not my average time. Sometimes it takes 2 weeks, sometimes it takes a month. But I don't think it's magic. I think it's that I stick to my knitting and I have a particularly tight sector. And so when something resonates, it resonates pretty quickly. The signals have to do with, are they using software beyond the screen? Are they CapEx light? Do they have, and then there's some CEO stuff. When I think about Wade at Zapier that I backed back in 2012, like there was a certain level of precision and intensity, right? Similar with Emmett at Twitch, for example, similar with Pete at Rocket Lab. There's like just this pattern, and it's not the only way to be, but there's a pattern of the CEOs that I've had success with backing that have a level of intensity, transparency, clarity, rapid follow-up. They rarely say, oh, let me ask my CTO, because these folks tend to be technical. They rarely say, let me check the bank balance for you. So at this early stage, they kind of like have their hands on everything, which is not appropriate 3 years later, but at that stage when I'm backing. So I found a few archetypes that fit well together that allow me to see when things click really quickly.
Yeah, no, that's a great explanation. And then going back to like software beyond the screen, would love to unpack that. Like, what does that mean to you? What are the filters when a company pitches you? Like, when is that outside your thesis? Would love to go down that thread a bit.
And maybe just to add a little just a little twist to what Brendan was saying. Um, I think it's not about software beyond the screen, but in our podcast, as we're trying to help these pre-seed founders approach folks like you in a more thorough and prepared manner. Like, what are the things that they got to know and think about before they show up? So, like, yeah, software beyond the screen may sound like a lot of people are doing it, but I'm sure there's ways you think about it, and there are things that they may or may not have thought about. So, yeah, talk a little bit about what does software beyond the screen mean? Like, when does it kind of go outside your scope? But really just tie it back to what do founders need to do to really, have you write a check for them?
Yeah. So the software beyond the screen thesis has to do with finding a problem that doesn't get a lot of attention from the typical tech nerd, that has not been picked over by a lot of software entrepreneurs, often because you couldn't physically get there. So you mentioned optical vision tests. If you think about, like, Vignesh, you have glasses once a year, once every 2 years, you go in, there's this machine, and a guy or gal says, is one better or is two better? Now that feels like it's 100 years old, because it is. That machine was invented 106 years ago to measure your diopters and all that kind of stuff. Now, you might say, yeah, but how are you going to put software there? You're not going to like jam a computer into that machine. And so software beyond the screen involves like careful, thoughtful injection of software, and sometimes it requires a little bit of new smart hardware. Sometimes it doesn't. Half of my 45 companies have no hardware, but they're still tied to a real world physical problem. Parallel Domain, for example, creates synthetic training data for autonomous vehicles. Ketrix handles regulatory compliance, so you can build your software for medical devices and robotics faster. But the companies that do have hardware, it tends to be pretty small. So we talked about Halter here. That's a relatively low-cost collar. It goes around your neck. Even the iBot vision exam kiosk is relatively small hardware, small low-cost hardware. So software beyond the screen has this element of first a kind of a fresh problem that's been in the real world that hasn't been addressed yet. Number two is a certain amount of discipline about trying to bite off less. This is at odds with what we might say, many VCs say, I back really ambitious entrepreneurs who are going after gigantic problems. I don't like that. I do something very different. Now, I still want gigantic outcomes, Rocket Lab, $45 billion, but I actually want entrepreneurs who are surgical experts at slicing off the most tractable part of a problem in the real world. So that means, you mentioned hospital robots. Andrea at Diligent Robots, her idea was not to have autonomy on a highway with kids in the backseat going 65 miles an hour. That is a very tricky problem, and it's taken Google Waymo like $50 billion of R&D to get there. Andrea at Diligent Robotics, her idea was to go 2 miles an hour in a hospital hallway, which, by the way, is regulated. It has certain sizes. It's always the same. A fancy word for computer vision and autonomy is fiducials, which are these markers. Hospitals have markers built around everywhere. So it's like, I like to say, the entrepreneurs I back, they're not chasing a gigantic problem. They're having a problem meet them halfway. So actually, Andrea sort of shrunk the size of the problem so that a reasonable amount of capital could get her to have live product in customers' hands that were generating revenue. And so what I love to see is entrepreneurs where $1 to $3 million, my typical check, will allow them to turn on real revenue. That's not always possible, but for most of the time it is possible. So that is another way I think about software beyond the screen is tractable problems, lightweight hardware, solving something real, and then embodies the elements we talked about earlier of over-the-air updates, the ability to have expansion revenue, to improve packages over time. And so maybe the second part of your question, Bignesh, about how to pitch me, how to pitch others like that. I sometimes think of pitching different stages of investors as to how much they have to know in advance. So when I invest, I do know I've soldered circuit boards, yesterday, and I do enjoy talking about microprocessors, and I do know about LoRa connectivity. The next round investor, when one of my seed babies goes out to raise a Series A, if they need to know about that, that's a very small pool of investors that know and love hardware. But if we can shift the conversation over the course of my runway with the company from product development and technology into business metrics, when they go out to raise a Series A, then we have a lot more investors who'll look at CAC and LTV and NRR and things like that. NPS, Net Promoter Score, a lot of acronyms there, but these are the acronyms that Series A VCs live in. So my goal is to take first-time technical founders, help them turn on the product, the software beyond the screen product, get in customers' hands, and then have a business that looks like a typical SaaS business to Series A VCs. It's not a typical SaaS business, but ought to have SaaS-like gross margins, and then we can get more people comfortable with it, have more bidders, get a more attractive valuation, and unlock access to capital. Because if you don't do that, I do a deep tech seed. Now I'm waiting to find a deep tech Series A, and we have to wait to find a deep tech Series B. That's a much riskier capital path than turning it into a business pitch early on.
And I think just to maybe toot your own horn and correct me on the stat, but your graduation rate from seed to Series A is incredibly high, and so I think that speaks a lot to the kind of the work that you do with your founders after you invest to help them kind of go from technical insight to being able to articulate what the business is. But I think maybe with that on how founders should approach you, and we can come back to this a little bit later. I think you had sent us a few areas you wanted to talk about, and this whole notion of moonshots, strangling, deep tech, disciplined deep tech, I think is the word you used, is a really interesting topic. And I think there's a whole bunch of reasons why it's happening, partially because of fund size of the mega funds, partially because of SaaSpocalypse. But let's just start kind of high level. Maybe you can frame the problem that you see in the market for us and why it exists, and then we can talk about what you think the solutions are and how deep tech will kind of move forward from here.
Yeah. And that sentiment comes from a blog post I wrote about 2 years ago. So way before SaaSpocalypse, this cancer on this sector has been prevalent, which is moonshots, deep tech culture, moonshot culture specifically. Moonshot culture, which is distinct from deep tech. Moonshot culture, Google X, the way that Astro Teller talks about stuff. There's it's sort of reveling in how weird it is. I think that the essence of this moonshot culture thing is that if you break off of the beaten path, if you're not doing a SaaS company, then you don't have to follow the rules. Moonshot culture says ignore all the rules. Let's throw them all out the window. I'm not going to raise a $2 million seed or $5 million seed. I'm going to raise a $500 million seed because I'm doing a moonshot. I'm not going to have board meetings because I'm doing a moonshot. Vignesh, you don't know what you're talking about. You're too dumb to understand. It's a moonshot. You see how this gets more and more abrasive? It sounds rude and annoying and obnoxious. One every 20 billion people is Steve Jobs, but it's not common, right? So most people should not be pursuing that path. The opposite path, the way that I prefer, and I think the right way to build companies, is to have an insight, have the capability to build it, make some progress, raise some capital, de-risk some items, retire some risk, raise more capital at higher valuation, de-risk some items, raise more capital. So staged capital, which is to be less dilutive, but also to avoid losing too much capital. My own startup, Triangulate, which I did in 2009, a machine learning powered dating startup, I raised $750,000 from great investors. Ultimately, it was unsuccessful, and I returned $120,000 of it. So I wasted $650,000, and as a result, like all my investors from Triangulate are investors in Ubiquity, which is cool. But I think there's something to be said for like careful discipline and not being enamored with your own technology, and then not, and I say this word very much on purpose, is not getting away with raising that much capital. So there are many examples, and it's a little more prevalent in the deep tech category. Theranos would be an easy example to pick on, like where no one did the technical diligence. There's rocket companies like this too, where they raised over $1 billion and never made it to orbit once because no one did the technical diligence. So this moonshot thing is annoying to me personally. It's also has implications for the sector. If there's enough moonshots in a category that fail, then everybody will run away and that sector has a nuclear winner, which makes me sad. It's sort of an annoying idea that you can pee in the pool, right, if you aren't careful with this stuff. So I think it is, SaaSpocalypse magnifies it because more folks are rushing in and then they think there's a whole new set of rules. I would argue there is not a whole new set of rules. Like you should look at deep tech very similar to how you look at SaaS, with staged capital, look for customer revenue, look for NPS, Net Promoter Score, not delay things too much. But you take something like the Humane AI pin, they raised $200 million, never launched. $200 million. And so $200 million is like the entirety of all the capital I've raised at Ubiquity. And that went down the drain with one company because people said they're ex-Apple. That's all the diligence you need. They're ex-Apple people. They're really, really great because they came from Apple. And I bet no one asked, what is the antenna? What's the battery? What's the chip architecture? What's the cloud latency? Things like that, where you need to know those things. And moonshots just say, hey, don't bother with those questions. Why are you asking? You're either in or out. And it's unfortunate.
And I think the other part of this that's kind of and maybe it ties back to Rocket Lab, and tell me if this is true or not. But I always believe in the necessity is the mother of invention. And when you can throw money at problems, you don't always have to find creative ways to solve problems. And I think great startups are always about finding creative ways to solve problems. And I'm curious, kind of what your thought is on that. Like, are you just finding that the level of creativity in some of these companies is actually lower just because they've raised so much money?
Oh yeah, of course. I mean, we saw a version of this when Masa and SoftBank were like permeating Silicon Valley with his ridiculous capital can stuff. What was it, like 7-10 years ago? When the companies he backed, I think the story was, and I don't know if this is true, but the stories were that someone would go try to raise 50 million from SoftBank. Masa would hit the table and say, what about 500 million? What could you do with 500 million? Logic would say if you can do something with 50, you can do even more with 500 million. But then the reality of humans being humans is when you have 500 million, everyone gets a little bit of a raise. Everyone's a little sloppy on CAC for marketing. And then I think almost all of those companies have failed. So it actually didn't work to overfund companies. And it turns out, even though folks would like to have a little more, would like to have a stronger balance sheet, have a war chest, have the capital cannon pointed away from them instead of towards them, none of that played out. So I think it is really important. Scarcity, while it's annoying, is actually an important part of startups. It does, as you're suggesting, it does drive a certain intensity, a certain creativity. It also allows you to create focus, right? I think most entrepreneurs I know have 20 more ideas for things they'd like to do, but because of the capital and the runway, they focus on one or two. And if they did all 20, there's a chance all 20 fail. So I think it's an important piece of the puzzle.
I was just going to make one point. It ties into this whole SaaSpocalypse. We're having more conversations with VCs that are like, I was doing software. I'm really looking at deep tech, physical AI right now. Obviously, that means more folks are kind of in the non-consensus, ironically, now more consensus circles with software beyond the screen. Given this space is being more saturated, more folks are investing, you kind of have to compete with these companies taking 15, 20, 50, 100 mil, sometimes a few hundred mil for their seed rounds, quote unquote. How do you stay disciplined? Like, how do you make sure you're still, finding alpha and, what's becoming more of a saturated category?
Like a
Yeah.
good co-host, Brendan, you read my mind. That was exactly where I was going to go, and it's. I think it's an interesting question, and so maybe talk about that, and then I want to come back to how should founders think about it, and kind of what's the lens founders should have. But yeah, where are you thinking about spending time and finding alpha?
Um, it's a good question. There are definitely more people coming into the space, which could be a good thing. More capital, more downstream capital, where I do a seed and there's more capital to support the Series A. There's definitely more sloppy capital, let's call it, capital that enables moonshots as opposed to accelerating disciplined customer development, product development. And so it's tricky to deal with. I don't know that I have any companies right now that have a moonshot funded competitor. But there are certain categories where, I do quite a bit in the space domain, and there's quite a few like subcategories of space that have gotten too much capital that are based on fundamentally flawed premise. And I could be wrong, and that's why we have many different VCs with different opinions. But so far, like many companies have raised a lot of money and failed in the space category. But I haven't invested in competitors to them, probably because the category itself had certain characteristics that weren't interesting. So that's one way, is to like by focusing on some of the business characteristics of a domain. Then so far I've only focused on areas where there haven't been moonshot competitors. Another solution to this conundrum is just as soon as a pond gets a little crowded, then you move to the next pond. And that's something I also think about a lot too, is like once, and I think people started to say this about SaaS like 3 years ago, I started hearing this idea that like, there's no more alpha in SaaS because we have so many metrics, so many frameworks that anybody can just apply the rule of 40 and those sort of things. And that's not totally true, but like it's become a science to the point where it's harder to find alpha. It's harder to find diamonds in the rough because it's been picked over by a lot of smart people who've dissected the right way to diligence companies and look for high-flying winners. That's not true in the deep tech category. But as more people come into an area and inflate the numbers, it's either going to have some sloppy capital, or you'll have too many companies with too large budgets, and they can all end up killing each other with marketing budgets sort of shooting at each other. So I can't go too much into my like brand newest stuff, but I'm always it's a sliding window of like, anytime something gets consensus, I sort of move on to the next area and try to find something that, again, looks really, really weird. Most of the investments I've made, most people I know thought they were stupid when I invested. And people say that, but that's what like non-consensus looks like. Many LPs of mine have called and said, why did you do that investment? That's pretty weird. They weren't telling me what to do, but they were expressing concern. And sometimes I'm wrong, sometimes I'm right. But like the key is to find alpha, you have to sort of be at that edge where it's non-consensus. And it looks pretty different than what most people think it looks like.
Perfect. You're back to enterprise software investing then.
I mean, when everybody thinks something is dumb, then that's a time to go back to it, I think. So.
Although ironically enough, I feel like in this world, one of the challenging things is that the amount of consensus capital that's happening downstream makes it harder for you to invest non-consensus early stage. And I think that thinking, I'm sure, gets into founders' heads as well. So like when you are looking at a space and you kind of have this disciplined approach, how do you think about actually, like, how do you convince them that it's the right strategy and the right path? Like, how do you make sure that the founder doesn't get swayed by kind of what's happening in the broader world out there? Like if you're a founder today and you're building something and it's like, hey, look, everybody else is raising like $30 million seed rounds. Like, why should I raise a $5 million or $10 million seed round and be a little bit disciplined? And look, and I think there's a part of that thought process that's kind of fair, which is like, if I don't raise it and I don't do this thing, then how am I going to be able to raise a Series A? Because like the benchmark and the metrics have changed so much. And so we'll come back to this question of like, how do founders position themselves? But like, just when you are at these early stages, going after these founders, going after different things, yes, there's less capital, but I'm sure they have kind of expectations of like, hey, here's where the market is. but that may not be the right thing. So I'm curious, kind of, how do you kind of guide them to think about that raise at the earliest stage?
I mean, so there's two places. It's when I'm making an investment. If a founder says to me, they're raising a $15 million seed, it's usually the end of the conversation with me, even before they tell me what they're doing or something like that. It's just my style is much more of like incremental capital to de-risk things. There's an argument that that's less dilutive. That is more founder friendly to raise less capital, make more progress before you raise the rest. Raise 3 million now, raise the next 12 when you have even more progress, possibly. Another way to look at it is that if a sector is that hot that you can obtain a $15 million seed, it's just not for me. Frankly, I'm not a big serial founder person. Like every VC I know loves second time repeat founders. Just not my thing. I mean, I think there's a certain program Ubiquity founders go through with coaching and advice and growth and things like that that's better tailored to first time founders. Valuations can often be higher for second time founders, and I don't actually think it's that much higher of a success rate either. So definitely not commensurate with the higher valuations doing serial founders. So all of the successes we've talked about today were first time founders. That's another way to stay away from it, is just avoiding hypey areas. I won't be able to convince someone if they're going out for 15 to raise 3. There's no point. But sometimes valuations and sectors get really hot. And back to my prior comment, then I'll start to pull back from those areas.
Sunil, wanted to talk about benchmarks. With this AI wave, the benchmarks keep going up and up and up. Often questions are like, how are you going to get to 100 million in not 8 to 10 years or 5+ years? It's the next 2 to 3 years. You've made some comments, maybe a little bit unfair, over-indexing, in some of the wrong, I would say, factors, especially in building the right foundation early on. Would love for you to talk about that a little bit too, because I think some of your successful companies have, sometimes not seen revenue to year 1 or year 2. I know you invest in deep tech, but talk about building the right foundation, why some of the benchmarks are a little bit dangerous in this market.
Yeah. This is a topic near and dear to my heart. I spend almost all my time with founders, and in the last year or so, founders have many pressures, but they have this extra pressure because VC firms are putting out this content marketing for their benefit to look smart with their metrics, but it actually just makes every founder feel worse. And I realize we should be spreading data, but it should be like balanced data, and it's skewed and a little misleading. And again, it gets for great headlines, right? Like Bessemer put out this report about AI supernovas and galaxies and stuff like that. I actually love astronomy, so I took offense with the use of astronomy words, but more importantly, the metrics and the wording was a little misleading. So it said 100 million in year 1 was on the chart. Supernovas, I think the idea is companies that get to 100 million in year 1. Well, when you look at it, it says 100 million of ARR in the first year of commercialization. Now that's a big distinction. This is very different than when you say, wow, they incorporated and they're already at 100 million. That's not what they're saying. They're saying they decided to start their own clock at T0. It could have been 4 years after incorporation. So that's just one of like 15 gripes I have with this particular thing. And again, it achieves the goal of people talking about it, like we're talking about it now, but it also has this like really annoying thing of making everybody worried about this when it's not the truth. I do think we've seen some acceleration where you're able to improve CAC, marketing, product development with AI. But the idea that the new baseline is 0 to 100 million 1 year after you incorporate, which is what the takeaway was for a lot of people. And then I think there was a lower hurdle, like a hypernova or something, which is only 50 million in the first year. I think it's extremely rare. It's great when it happens. The stars have to align, but and I know venture is all about the outliers. We talk a lot about the bimodal distribution of like most will fail, a small number will succeed. I think it's a similar percentage, and even hyper small number that achieve those kind of metrics. And it's great. I don't mean to put that down, but I don't think it's the right hurdle to be pointing folks to. I don't think any VCs I know are waiting for those kind of numbers to emerge. So sort of a misleading content marketing game that I think had some real repercussions on psyche throughout the industry.
But let me push back on that a little bit. Not necessarily the data point. I think you're spot on. Like there just aren't that many companies that do this. But I think the flip side of it and the challenge is it's like, hey, 1 to 3 isn't good enough anymore. You got to be like 1 to 10 or 20. Just making up numbers here. And And look, and I think in certain categories it makes sense. There's like a a rush. You got to get there. I get it, but then you're talking about something like maybe Halter as an example. Like, it's just like there are like physical limitations. Like turns out you got to put the collar on the cow first and like test it out in the field for like 6 months, 8 months, and like know that the thing is gonna split off or break because like the cow likes to do whatever. Right. So there's those certain I guess physics against building companies at a certain scale depending on the category. But I think you're getting to this point where everybody's just like painting a broad stroke over all companies and kind of how they should be built. And so then as you think about the deals that you do and going from step one to raising the next round and subsequent rounds, how are you kind of coaching the founders to think about the milestones? Like, has it changed in any way meaningfully? Like, how do you make sure that they get set up in the right way so that they can actually go raise that next round?
Yeah, it's a good question. I'm not a big fan of benchmarks in general. I think folks sort of over fixate them. Let me not call them benchmarks. Rules of thumb is the right word for it. So people say triple, triple, double, double, meaning like your first year you triple revenue, next year you triple revenue, and then growth slows to doubling revenue. I think founders, myself included, when I was a founder in 2009, are awash. Like we're walking through the abyss, and so anytime someone throws you a bone, you like latch onto it. So for a few years ago, everyone said you got to be at 1 million of ARR to raise a Series A. Very broad strokes, like you were saying, Vignesh. It also whenever once a year we have all the Ubiquity CEOs come together at the Ubiquity CEO Summit at the Computer History Museum, and I have a panel with 3 VCs every year, 3 friends that are Series A, Series B, closed doors, so they can say whatever they want. And without fail, we've had our 8th summit last year in September. Every time, folks I'll push, hey, what is the new hurdle for a Series A? And I'm trying to help my seed stage CEOs answer this question. And I'll push and push. I'm like, what's the number? And they're like, there's not really a number. And then I'll push and say like, hey, because this is my friend, what do you think the number is? And they're like, no, it's not about that. And then I'll ask them like, hey, your last deal, what was the hurdle? They're like, well, they had 2 excited customers that were going to expand, or they secured this customer that had never bought anything before. So to me, at least at the Series A, it's always about the quality of the revenue, the quality of the expansion potential, the uniqueness of the product. Like it's very rarely just like hitting a revenue hurdle. I think if you don't have that, then you have to rely on a plain old revenue hurdle. And I do think the plain old fallback revenue hurdle has gone up. Maybe it used to be 1 million, maybe it's 2 million now. I think that reflects like quicker product development with AI. I think it reflects quicker tooling with AI-powered sales SDRs and AI-powered marketing acquisition, things like that. But for most of the most interesting companies, I don't think the growth happens immediately. A more negative pointed way to say that is easy come, easy go, right? If you're able to build something in 2 weeks, which is sort of the YC, 10 weeks, build something in 10 weeks and have 10% week on week growth, you have to ask the question. It forces the question, like, couldn't someone else do this, right? How much durability is there in this? How easily could the customers churn? Are these LOIs or is it headline revenue? So it's double-edged at the very least.
Do you and maybe to think about this like from a again slightly different lens, going back to this investor question, Brendan pointed this out earlier. There's just a lot more folks going after physical AI, and again, I think part of that is bigger funds. You got to find places where you can deploy more capital, and then obviously everybody worries about kind of just defensibility in SaaS, so this whole SaaS apocalypse kind of notion. And I know you have some pretty strong opinions on this, but like talk a little bit about what you're seeing for founders. Like, what are the mistakes that you're now seeing? Like, what are people doing that because of this flood of capital is enabling? Like if I'm a deep tech founder today, like what are the things that I should be avoiding given kind of the the noise in the market?
I have advice, but I don't know that it's very different today. It's just sort of some timeless advice, 2 or 3 things that kind of can make a founder go crazy or can make a founder sort of lose interest from a VC. The first is a really natural mistake, but I think it's one of the biggest mistakes, is to compare yourself to others. In particular, a founder will say, this other company had 1 customer and they raised at a $50 million valuation. I have 2. And the thing we don't talk a lot about in our venture industry is that our transactions are one person on earth wants to buy one share of one company. Now, that's not really a strong basis for valuation, right? A better valuation is public markets where hundreds or thousands of people are buying and selling, and you make a book and you see the market clearing price. In our world, when you compare yourself to someone else's transaction, we see this much more at the later stages. It's just based on one person who had other incentives, other motives along the way that set the valuation. So it's tricky to try to do the logical thing, which is how much traction do I have? How much traction do they have? They got this valuation, so I should have that same story. And bankers will do this when you prepare to go public, but that's again because it's a whole bunch of buyers and sellers. But when it's a single person transaction, single buyer transaction, as most venture transactions are, it's a tricky thing. So I think I've seen many founders spin their wheels and just kind of build up a lot of angst about this because they heard someone else raised. There's also more technical reasons where someone had extra, like full ratchet anti-dilution or 3x hurdles, so you never get the full story. So I think that's a thing to be careful with. Another element where founders can get a little can act against their own best interest is figuring out how much pressure to apply. You see this, I think I'm seeing this more these days, is folks reach out and say, hey, I'm closing the round next week. Are you interested? As the first conversation. And it's a delicate balance. Entrepreneurs juggle a lot of balls, VCs juggle a lot of balls. So how do you make sure that you're at the top of my list where I'm spending my time? One way is through pressure, but sort of titrating that is a delicate balance. And if you overplay your hands, a lot of folks will just say, sorry, I don't have time. And then you sort of lose them along the way. So that's coming up a little bit more than normal right now. Another one is not having good answers when folks ask about what the larger companies might do. I actually don't think some of the Anthropics, OpenAIs are going to enter that many of these other startups areas, but you want to have a smart, careful dissection of that. So that question has been around forever. Like back in the early 2000s, it's what if Google enters your business? Or, what if Facebook does this? Or now it's what if OpenAI or Anthropic does this? And I think folks should have a serious kind of dissection of, well, here are the possibilities. Here's what I would do in each of those situations. Here's why I don't think it's a possible thing. I think that reflects some maturity, and it is a ongoing kind of cloud over the whole sector. Is these companies with these very large valuations will eventually have to justify with a more broader set of products and broader set of revenue streams, and so it may be an existential threat to your startup if you're building on them.
Sunil, going back to building Ubiquity, I know we don't have to talk about hiring because you're a solo GP, but would love to talk about some of the programs you've created, the thinking behind those, how folks can access them, give you a little plug as well. But Ubiquity University, really cool initiative. You talked about it a little bit, eating your own dog food a little bit, with your own portfolio on that.
Yeah.
And then the other thing, I see these people with, you have, by the way, the best swag, I think, the nerd hats, but you kind of have this coalition, I think, of what you call your nerd advisory board or something like that, which I'm sure they give you a lot of great advice along the way and kind of going through these deep tech deals that you're looking at. So we'd love to hear a little bit more about that.
Yeah. So when I was younger, in high school, I made a Tetris program. And when you're writing code, one of the things I was trying to do was center, the word Tetris on the screen. It was 25 by 80 DOS, writing C++. But the key is you're trying to center the word Tetris. And so you write some extra code that figures out how to center the word Tetris. And then on a different screen in the Tetris game, you're trying to center the word score, let's say your high score. And so the first time you do that, you write the same code a second time. You're like, that's a little annoying. I had to write that code a second time. What you end up doing is you take that snippet of code and you move it into a function. This is called refactoring code. So anytime you repeat yourself, now this is codified in a programming principle, DRY, don't repeat yourself. And so anytime I catch myself around Ubiquity doing something twice, and I really mean this is how it works as a solo GP, I will make it a keyboard shortcut, I will make it a Notion template, I will make it a file, anything. So when that CEO summit that I mentioned, that I run every year, it's a template. Like I have the vendor, I have this. So Ubiquity University came out of this idea that early on in Ubiquity, I found it required and flattering when one of my founders would ask me for advice about something. One of my founders would email and say, "Hey, Sunil, I want to make an offer to a CTO. Can you and I talk about the right level of equity and other considerations?" We'd set up a call. We'd talk for 20 minutes. Great. I'm being helpful. They got a lot of value. Win-win. 2 weeks later, a different founder would email and say, "Hey, Sunil, I want to get your thoughts on equity for a CTO." And I'm starting to think, oh, shoot, this feels duplicative. So with Ubiquity University, what I actually thought was I'll make a secret password protected vault of my advice. I will record this stuff. Eventually, I figured I will record it really nicely. I'll spend an extra hour and actually make it really clear content, good visuals. And eventually, I, with the help of my coach, decided to actually open this up to the world. So Ubiquity University now is a free public resource with 5 to 15 minute how-to videos for early stage entrepreneurs. I think it's one of the best out there. How do you build your first cap table? How do you run your first board meeting? Some of the stuff is tactics. How do you make that board deck? A lot of it is mindset. How do you think about OKRs? How do you think about running a good board meeting? How do you think about early customer development? And so these all were born out of something where it came up twice in my life, and I said, you know what, let's make a Ubiquity University module. Halter just raised this new $2 billion valuation round from Founders Fund. And so I had Craig, I interviewed Craig to talk about for 15 minutes, what are his top lessons for raising capital when it's a weird deep tech idea, like cows on collars. I interviewed his head of hardware, Andy McLaren. What is his tips for shipping your generation 1 hardware? Halter now has 1 million collars in the field. So trying to share advice from the portfolio is also where it's evolved to, but the initial genesis was recapturing some of my time by recording and upgrading my advice so that I could send it to my portfolio. And now it's got these other benefits. So I'm proud to say it's used by like a dozen universities in the entrepreneurship program. And it tends to be a resource where folks in the Khan Academy mindset can sort of rewind, go back over stuff. A couple of them actually have follow-on materials, like the Build Your First Financial Model has a Google Sheets template. And I made for your financial model, I made that really specifically. One of my companies in a board meeting said, sorry, last board meeting, we said our cash was out in 12 months. It's actually out in 6 months. Now, as a VC, that's one of the most scariest things in the world, is like cash runway. And I said, how did this happen? And they said, oh, well, we had downloaded this 4 megabyte Excel model from a big VC firm, and we didn't use all the tabs. So they were using the wrong tool. That infuriated me. So I went to Google Sheets in 10 minutes, whipped up a really basic month-by-month, revenue minus COGS minus salaries. And that's now available at Ubiquity University. So part of it is fixing my portfolio, but while I do it, I share it with the world. And that's actually,
I love it. A mix of sharing wisdom and also efficiency. You're like a time management whiz. I've learned and like noted things over the years, and you have to be, right, to be a solo GP and manage 40 plus portfolio companies. One of the things we wanted to end on, like, you love space.
Mm-hmm.
I remember having a conversation with you back in the day, and just kind of telling me about the future of the industry, and obviously very relevant right now. Artemis 2, Project Hail Mary's out. When saw that on IMAX.
Nice.
Great movie, great book. Obviously, you've talked about Contact a lot over the years, how it's like one of your favorite books. Talk about the future of the industry. Like, what's getting you excited? Where do you see this going? What do you see kind of the near-term applications that you think will be most important, and then long-term, like, what's getting you excited the most?
These are really good questions. So I do love astronomy, like Hail Mary, and also like cosmology and galaxies and SETI, the extraterrestrial intelligence. But if we confine it to the commercial space category, I've made a few investments over the years. Rocket Lab, which is a rocket; Spire, which is a small radio frequency-based satellite for sensing, satellite constellation. Both of those are now public. And then Loft Orbital, which is allowing you to rent space on their satellites, kind of like how you Airbnb your home when you're not in it, and you can rent, and then doing that with constellations. And then Muon Space, and then another undisclosed one I just made a few weeks ago. So I do like the space sector. I think it is easy to lose your shirt, so you have to be careful with finding a space, the right balance of like enough space expertise, but not too much. So they know the lessons of the past, but they're not obsessed with the lessons from the past. And so they can sort of short circuit some of the hiccups. the potholes, but then also are willing to reevaluate first principles and save money wherever possible. Some examples of that are like you can buy like a $25,000 star tracker, or you can try to make one yourself for $10. And so like there's a lot of these decisions along the way. Do you vertically integrate and things like that? More broadly, things in the space category, they launch, SpaceX dominates in the launch category at the moment. Rocket Lab is as a second in that category. I'm not super personally excited about new launch vehicles. I think at the moment the push is for Starship to come online to take the cost to launching something to orbit even lower. It was $25,000 per kilogram with like Space Shuttle and a few other things, and Rocket Lab was trying to get it lower. I think $5,000 per kilogram, and then SpaceX is taking it even lower. And when Starship comes online, I hear it's in the hundreds or $100 per kilogram. So what that does is allow more people to utilize space. So the next question is, what are we going to use it for? Historically, space has been used for military, like defense or communications. That's like 95% of it. There's a tiny bit around Earth observation, like Planet Labs looking at the deforestation of Brazil, but turns out there's not a lot of money in that, unfortunately, and that's all of our faults. Most of it is watching, monitoring, hurting each other, military, or like watching TV and internet, right, is the vast majority, so bouncing signals back and forth. I think a new category has emerged, or two new categories have emerged in the last few years. One is one I've wanted to invest in since I got serious about space in 2014. So for 12 years, I've been monitoring the sector. I still have not invested, but microgravity production, which is using the unique environment of space where things don't get pulled down when you're in microgravity in orbit, to do things like crystal production or drug production or organ production, because you can achieve different outcomes as a result. The flip side is you got to bring it back down to Earth. Now, I was talking about $200 per kilogram to get something up, way more expensive to get something down, because you have to go from 17,000 miles an hour, hit all the air molecules, get really hot, and pick up this capsule. So deorbiting microgravity production is very tricky. So the keywords there are high value, low mass. So everyone's been looking for like, what is the right molecule or the right crystal, silicon crystal or whatever, Z-bland, which is a special kind of optical fiber. Like, what is the thing we could make in space that would be worth the trouble? That's one of the two categories. The second category is this new emerging, which I haven't made up my mind just yet. It's just data centers in space. I think the alluring part of it is people say, oh, space is cold, like 4 degrees, like negative 273 or something, negative 271. But it turns out that like cooling data centers is actually really tricky, because you don't have conduction or convection. So you actually have to only use RF, electromagnetic radiation. So you need a big solar panel, and then you also need a big radiator, meaning you're pumping fluid around and it's emitting black body radiation. So it's like a lot trickier than people say, a lot trickier than people think. If you look at a picture of the space station, you see huge solar panels and you also see huge radiators. Another part of it is data centers and computers break. You're not going to service them. So I have one investment that kind of plays to that, like reconfigurable machine learning chips, but where you would have them up in space and reconfigure them after the fact. But those are the two interesting areas. I think we'll see more. I have not crossed the chasm into what we call like cislunar, which is like stuff related to the moon outside of geo, kind of on the way to the moon, whether it's moon bases or moon data centers or moon mining. Definitely haven't done anything with Mars. Definitely haven't done anything with deep space. I don't think those are in the purview of traditional venture capital, where within 10 years you can invest and see an exit. But I'm excited more folks are coming into the area. I'm excited it's easier and easier to tinker and invent more ideas and think of stuff that doesn't even cross my radar. And that's the most exciting parts, is the new ideas I haven't heard of yet.
So is Contact still the GOAT book in your mind? Did Project Hail Mary eclipse it? What's the GOAT?
That's a great question. I will tell you, Project Hail Mary is the first book in my life that I picked up and read the whole book without moving, which is like just a massive indicator of how addictive it was. And I like the movie, but Andy Weir from The Martian and now Hail Mary just has this writing style that really scratches my itch about just being nerdy enough. He works out the numbers in the literature for all the calculations and stuff, which is fun. I still think of Contact as just a really beautiful movie. Carl Sagan was really an incredible science popularizer and communicator, and this was one of his marquee books. Later, the Matthew McConaughey, Jodie Foster movie. But the idea of finding if we have cosmic company, I think, is one of the most important and inspiring ideas in the universe. And I think we are in a unique period where we had no idea like 30 years ago. Now we've really bounded the problem, and it looks very promising. I won't say that it's likely, but there's this fancy formula called the Drake equation. It's more of a search filter. How many galaxies, how many planets per galaxy, how many planets might have life? You kind of roll the numbers forward, and we've kind of resolved like 6 or 7 of the parameters, and we had like 0 resolved 30 years ago. So we now know that when you look at the sky, this is the most inspiring part of sort of the contact, almost the appendix, but it happened in real life, is that when you look at the sky, all the stars you see, there's about 3,000 stars you can see in the visible thing. There's 100 billion in the galaxy. There's 100 billion galaxies. So there's a lot of stars. About 20% of them have a planet like Earth, which is mind-blowing. So, and we had no idea of either of those numbers a few years ago. So I think we're making progress. I volunteer and donate a little bit to the cause, and would love to see more progress there, because it's arguably the most important question in the world.
Perfect. Well, we'll make it episode 2. Sunil confirms life not beyond Earth. So
Yes.
That'll be a good headline. So,
And if not life beyond Earth, definitely data centers in space will be a thing. So
We'll find out soon.
yeah, exactly. All right. Well, Sunil, really appreciate you coming on, man. This has been super interesting, and I think it's a really good way to end it on kind of the areas that you're excited about, and how we should be thinking about life beyond Earth. But thanks for taking the time.
Sounds good. Thanks, Brandon. Thanks, Vignesh. Really enjoyed it.
thanks,
Thanks,
Sunil.
Sunil.